Welcome to the Sojourn Wealth Management Podcast. My name is Jeff Bronner, and I'm joined by Corey Akins and Andrew Kraft. Today, we're going to be continuing our series on investment basics, and we're going to be talking about equities today. How y'all doing?
Doing great. Looking forward to this.
Doing awesome. Well. Happy fall, y'all.
Happy fall. So let's start off with
Can we delete that out?
It's fall, y'all. What are equities?
Great question. I think most people hear the term and the phrase home equity. And so I guess the best way is to kind of jump on that. Equity means you own your home, right? So ownership of a business.
Yeah.
Or also known, AKA stock.
Yeah. I think that's what most people probably think about too when they see, the New York Stock Exchange and kind of where they're traded at. But just simply it's ownership, and typically in our world, publicly traded or private companies. And that's kind of where you get the exchanges and, what's been made popular in cinematic history, right? Yeah.
So in a kind of a redundant way, when you buy equities, you own ownership.
Yeah, you're owning a part of that company.
Right.
So like you can buy shares of, say Apple stock, and you're a minority owner probably within Apple's, company structure. And then that stock or the shares of that stock are then going up and down in the marketplace based on value and other factors.
And if you're a majority holder, you're probably doing pretty well for yourself.
Yeah, that's right. If you had bought Apple stock like years ago, yeah, you're probably doing great, right?
So what are the different types of equities?
Yeah, generally speaking, common or preferred is the the two that you're going to see the most of, right? Mm-hmm. So common stocks, they offer the voting rights. Like you have a say in what the company does. You get to vote each year. There can be dividends. So dividends are just when a company's profitable, they send that profit through to their shareholders, and then common stocks are greatly, they're tied to the company's performance and value.
And those are the ones that most often when people are buying stock, they're buying common stock.
That's right. That's the most popular. The other type is preferred. So that's more of like fixed dividends and
that's just by title.
Yeah. So like in the structure of like a company, who they pay out first, obviously a company is going to pay out those who they owe money to first, and then preferred stockholders are going to be above common stockholders, kind of in like the liquidation process. But basically they provide more fixed dividends on the distribution side. So like when you have preferred stock, you're typically looking for that dividend to be consistent and fixed as a source of income.
Yeah, I took that question a little bit more broadly in the sense of what types of stocks, and there are big company stocks like you said, Apple or Exxon, and then smaller company stocks. Can't think of any off the top of my head, but some an international,
maybe more regional based,
a regional based company or an international stock like Toyota or whatever. Yeah. So some that are growing really fast, and some that have been around for a long time, and you don't expect it to grow that much. But so a lot of different types of stocks you can use to invest in.
Yeah, talk more about that too, Andrew, because like that example of Apple 30 or 40 years ago, like that was not what it is today, right? So that would have been considered small cap at that time, or even prior to that, like before they went public. So that's what you're saying, right?
Yeah, as a company just launches, goes public, starts that public offering on the stock exchange, that typically starts out as like a small cap growth because the company is growing, reinvesting a lot of revenues in the company, so the price is going up. And then let's fast forward a couple of decades, for example, and you have a large market share, international reach perhaps, and so the stock is still going up because it's a valuable company, it's a valuable business, and if you own ownership, like you said, Jeff, then you want the company to do well, but it just typically pays out in profits. And I don't know if later on we're going to get to this, but I think maybe it's a good time to step back and just kind of describe what all those terms mean. I know we've talked in general about, I guess, investing, but if we kind of take it in very basic terms, if someone's going to start a company to perhaps create those ubiquitous items, a widget. And so if they save money or borrow money to then build a warehouse, but they want to expand, they could go to someone else and say, "Hey, I don't want to borrow any more money. Do you want to become a partial owner?"
Mm-hmm.
And they would get a capital infusion, get a bunch of cash, build this thing, and now they sold, in a sense, part of the company. And so as the company does well, he'll pay that partner, so to speak. So, but also there's all that risk. We've talked about that in the past too, right? Where owner of a company has more risk.
Right.
One of our previous podcasts, I think.
Yeah, we did.
Yeah, I was just going to add on to, right now, some of the growth of what you're saying, it reminds me of like AI, right? Like over the last several years, as those companies have kind of become more public, right? Like that's just kind of an industry that has dominated that space, and now obviously moving larger. But yeah, exactly right, Jeff.
And just to add some further terminology, because there's a lot of different words and phrases that we might use. If we say large cap or mid cap or small cap, we're talking about what's called market capitalization, how much the overall ownership of that company is valued at. So when you say small cap, these are smaller companies. And as a small company grows, they might move into a category of mid cap and then large cap and even mega cap.
Yeah. And just to put some numbers to that, right? Like, so small cap, that's companies with a market cap between 250 million and 2 billion.
Mm-hmm.
Mid cap, 2 billion to 10 billion. Large cap, over 10 billion. And then that mega cap, much larger even.
And that's simply the number of outstanding shares multiplied by the share price.
Right.
So kind of like what you're saying, Jeff, the better it does, the more that are owned.
And that helps us. Our next question we want to talk about is, how do they work? And how is this used for clients? Well, if you invest in a company and their capitalization goes up, well, the value that you own proportionately goes up to the percentage that you own of that company. And so when we look at investing in equities, typically the strategy is you want to go for growth.
That's why your friend who invested in 6 of the crypto companies back 10 years ago was constantly on his phone telling you about his investments and looking at the market, right? Because he's looking at his investment go up and down with the ownership in that company.
Perhaps. I don't know if you're referring to a specific one of my friends. Or
No.
Everybody's got
the listener's friend. The listener's friend. Everybody knows.
You're locking eyes with me.
No, everybody knows a guy like that who's on his phone, constantly looking at his investments, and it's like that's kind of what you're getting at with that's the extreme example, I guess.
Yeah, everybody does know a guy like that, I think.
Although I would say that oftentimes speculating can be mistaken for investing.
Yes.
You invest to become an owner, partial owner, small, very, very minority owner of a business, hoping that over the long term, like you said, it will grow, both in the value of the business and in the profits or income called dividends that's paying out, as opposed to just buying a stock to hold it for a day or two or a cryptocurrency. I don't know what the different ones are called, but hoping that it goes up and you can sell real quick.
So let's unpack. You guys have both talked about dividends. We've talked about growth. Let's unpack more of the features of what someone would expect when they invest in equities. So I would say 3 key things would be the dividends, growth, also liquidity. So let's just unpack more of that to build that out a little bit more. Take whichever one you guys want and run with it.
So I think it's part of a larger conversation that we have done in the past about diversification in your investments. So to your point, Andrew, you probably don't want to just, hit my mic. You probably don't want to just invest in 1 or 2 companies, right?
Right.
Yeah. So you want to invest and have ownership across a broad spectrum of companies, both here and internationally, to help with your risk, because inevitably ownership in companies or equity in companies is going to carry more risk because you're tied to how that company does or how they're valued or the economic factors surrounding their industry. And so I think that's kind of a key as far as people buy equities because they want to, over time, outperform inflation and get greater returns, right? They're looking and expecting the companies to do well over the long term. So that would be my kind of initial thoughts on it.
Yeah. And the fact that they can get in and out through the public stock exchange relatively easy, makes them a little bit more liquid than, owning an actual business.
Right.
You have to sell a business, takes a while, but if you have stock in a company, you can sell it.
Or owning actual real estate.
Right.
Right. So like another place where you kind of get both of those is in the REIT structure,
like
right?
A rental house.
Yeah. Right. So like you take the example of actually owning the house in Knoxville that you rent out and all of the things that you have to do or that come with that versus if you invest in an exchange where you're owning the real estate through the market.
Yeah.
So that kind of,
I think it's a good analogy. If you take that, the Airbnb or whatever, that home is increasing in value, well, going up and down, but over time, real estate goes up. Like they say, God's not making more land.
Yeah.
And so that home is, appreciating over time, much like the stock price appreciates over time. And then as you pay for the cleaning services or the rental service, and then people rent, you're going to have hopefully a profit margin there. And so the same thing, the company or the stock that you own hopefully has profits that will pay out to the owners in the form of dividends. I think you mentioned, the dividend earlier. And so that's just a profit that you get as an ownership of the stock. And so I think some of those kind of key features are, it's liquid. You can kind of get in and out much easier than actually owning a business or a rental home. You can get, a stock that pays a dividend, so you can start getting income from that. Now, you might purposefully choose a stock that's not paying a dividend because you think the long-term, potential or prospects for growth rather are a lot better. So there's different types of stocks, but I think those are some of the key features, I guess.
Yeah. And you guys are kind of answering the next question, which is why. So they have these features. Why would someone want those features and what would they be used for? And one of the ones you mentioned, Corey, is growth. But there's also, you can have an equity strategy that's producing income.
Yeah.
And I think part of just building off that example with real estate of, the difference between, if you invested $200,000 into a home and you want to get that $200,000 out, you're gonna have to go through the market. You're gonna have to go through, and that's not a liquid investment. You can't get that cash out, but because of the public traded nature of, like you mentioned, Andrew, you can get the equity out of your stock portfolio relatively quickly because you can sell it whatever the market price is that day.
Yeah, absolutely.
New York Stock Exchange, London Stock Exchange, or coming in 2026, the Texas Stock.
Is that the Dallas
That's right.
Stock Exchange? So one thing that we've not talked is also voting rights. Right. So like there is the
often overlooked.
Yeah, often overlooked, but also important because say, you could just say, well, I just want a diversified portfolio. I don't really have an opinion one way or the other. But if you do have some conviction around the companies that you want to own, right? Like that's important because then you can buy shares of companies that align with your values, align with your convictions, and you get an actual say in many ways through owning shares of that company. And that I think that was a lot more popular 50, 60 years ago, where you see some of the takeovers and things like that, where people were, wanting to steer companies a certain direction. But, I think it's important today as well.
Yeah. And I think that the reason that it's trended away from what you're describing, 50, 60 years ago is because we've become a little more detached.
Yes.
Because of the nature of investing now is through these, whether a workplace plan or what have you, going into mutual funds or ETFs. And
it's very abstract.
Right. And so one of the things that we've done a lot of research on is looking at fund managers who would vote in a way in which would reflect the values of the people who are investing. So that's another way we can look at that. But yeah, the overall point with voting rights is significant and should be discussed.
Yeah, your original question, I kind of went off the rails there, but your original question was the why behind investing in equities. I think it gives you options in a lot of different ways. And then you tie that to the ability to see long-term growth That's why it's the main chassis of a lot of portfolios.
Yeah. You mentioned the outpacing inflation earlier.
Mm-hmm.
I think that's the one big key is you want to invest and be an owner of a business. And if you just kind of think of historically, I'm not going to use the terms right, but what like the capitalist and the proletariat or the whatever it is, like, well, the worker it usually is defended because they're not getting as much as the owner of the business. Well, the owner of the business is taking a lot more risk,
right.
borrowing money, investing their own capital, that kind of thing. And so their return should be probably more than someone just getting a salary who, if the company goes under, the owner is on the hook, whereas an employee can possibly, hopefully go find a job somewhere else.
You bring up a good point too, because it gives you the ability to own shares without personal liability too.
Good point.
Mm-hmm. So in your example, Andrew, if you go buy the painting company, like you go start a painting company and 2 years down the road, you have to close shop. Well, you are probably on the hook personally and professionally for the financial, mishap there, right?
Yeah.
And so it gives you the ability to kind of hedge some of that risk as well. Like you could lose your investment, but that's all you could. It's not like the IRS is going to come after your personal assets.
And it gets back to the conversation we had started when we did the workplace retirement plan episode, talking about how it's a lot more accessible for the everyday person to build a portfolio and get invested in the market and things like that. We live in a very fortunate time, but that also means that people need to be educated. They need to know how to navigate this space. So
exactly.
We appreciate y'all's time and listening, and we do encourage, if you have questions, feel free to reach out to us. Thank you for listening to this episode of the Sojourn Wealth Management Podcast. This is a friendly reminder that all content in this podcast is intended for educational purposes alone. Nothing in this episode should be treated as tax, legal, or investment advice. We encourage you to consult your financial professional for any of those needs. Securities offered through Kestra Investment Services, LLC, Kestra IS, member FINRA SIPC. Investment advisory services offered through Kestra Advisory Services, LLC, Kestra AS, an affiliate of Kestra IS. Kestra IS or Kestra AS are not affiliated with Sojourn Wealth Management, LLC.